Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. If you're a Fortune 500 company today, you have a variety of different ways to market, to try to get new customers, retain current customers, or otherwise sell your product. Of course, you could use the various different digital advertising channels depending on what sort of company you are. If you're Nike or Disney or whoever, you could advertise on Meta, you could advertise on Google, you can advertise, if you have a presence on an Amazon, you could buy sponsored listings and put your stuff there. Increasingly so, you're able to advertise through channels such as Spotify or Netflix as well. There's a variety of different ways to advertise online. There's traditional marketing. You can advertise through billboards, advertisements with posters inside of public transit, such as buses and trains and so on and so forth. Additionally, you could do sort of like legacy advertising through cable television and so on and so forth. There is a variety of different ways that you can advertise. And so historically, for particularly over the past 2 decades, there has been the need for an enterprise-grade software that is essentially able to track your customers or track these potential leads. And this has traditionally been in your quote-unquote own 4 walls. If you're Nike and you have people going onto the Nike website, putting their email in, making an account with you, you have a view onto the customer records and the data and the purchase history of that customer in specific. You don't necessarily have any sort of clue if that same customer is going over to Adidas and also purchasing some items. And these companies, these softwares that have been built up over the past 2 decades have prided themselves over the fact that your customer data is going to stay private. If you're Nike and you're putting your customers' transaction data inside of the Salesforce Marketing Cloud, that is going to stay private, and we are not going to share your data with Adidas's data. We're not going to blend those two. But ladies and gentlemen, for the first time in history, there's come a company where through a very unique strategy has been able to track what you're doing and what your interests potentially are interacting with Nike's assets, and based off of that information, potentially put an ad in front of you that maybe you're going to buy an Adidas sweater instead. If you are potentially looking at auto insurance, if you're looking at a newsletter, looking at how to potentially reduce your auto insurance bills, maybe that information was gathered from Geico, but then based off of that information, we can maybe put an ad for a Ford F-150 pickup truck, and you might be interested in possibly buying that. And then based off of historical examples of putting an ad in front of a person after they've clicked through an auto insurance newsletter, they're able to predict the odds of you potentially purchasing that truck and looking at the 5 to 10 actions prior to a purchase decision to maximize return on investment for marketing spend. Ladies and gentlemen, this company exists on the public markets today and is known as Zeta Global. Now, that's a very high level explanation that I just give you. For the scope of today's video, we're not going to do some sort of hour-long deep dive into the exact intricacies of this platform. If you're interested to learn a little bit more about that, I'll link this in the description. Nick Wealthmatica, he's also on Twitter. He did a very in-depth breakdown of the business if you're curious to learn more. But I just wanted to get on here and kind of give you guys an update as to what I'm doing with my Zeta position. Of course, earlier in the month, I did make a video talking about how I'm investing in this business. It's one of the quote-unquote widest moats you've never heard of, and I wholeheartedly believe that. And even though the shares are down a little bit since my initial purchase price, I'm perfectly happy continuing to buy into this phenomenal business. And by the way, if you're curious to track my live moves, you can do so completely for free. It's over on Blossom. This is the live version of the portfolio down to the literal second in terms of my trades and what positions I'm buying and whatnot. Again, completely for free. There's a link for that in the description. In addition to that, they have a whole lot of different assets on the platform here. There's an earnings calendar, which is pretty relevant for us during earnings season, of course. So if you're curious to check that out, Blossom, my live portfolio, along with all those different things linked in the description down below. But with that being said, more in terms of Zeta, I did in fact increase my position ever so slightly. I put about $1,000 more into it. It now represents roughly 8.3% of my portfolio. I have about 450 shares, and I'm continuing to buy this business over some of my other ideas that I also think are undervalued. To be honest with you, I think everything, from Adobe down, all these 4 different companies I'm kind of interested in buying a little bit more of. And so the reason why I continue to buy Zeta over some of those other ideas is because I wholeheartedly believe in the sort of long-term potential of this business. And I think it's extremely undervalued relative to those other options. If we jump over to fiscal and we toggle on something like the EV to sales ratio, you could see that earlier today it closed out roughly 3.5 times EV to sales. Now again, this is sort of like a SaaS style marketing technology style business, and usually these sort of companies command a pretty high valuation. We could look at something like, for example, Trade Desk. Now, of course, granted, more recently this business has completely been obliterated. I mean, it's trading at 5 times EV to sales. This is the lowest valuation since you got to go back all the way to like 2018 to find those valuations. And so this business is a little bit more challenged in terms of they have some growth scares. I believe Amazon has started to compete with them head to head, and I believe Amazon is actually slashing prices in terms of their offering and has started to take sort of market share from Trade Desk. So this business has its own set of challenges that they're kind of going through. But, if we look across the decade, like this company had commanded a pretty premium valuation, frequently trading at north of 10 times sales. Now, I'm not saying Zeta needs to go to that valuation to work out as an investment, but that's sort of like the ceiling or sort of the upside with a stock like this. But even if that isn't achieved, you still have organic growth of roughly 20% with this business. They are currently growing faster than that, partially driven by an acquisition that they did last year. They continuously do some sort of acquisitions to strategically make their product offering better. At the same time, if we jump over to their investor relations page, we can see that on a revenue basis, they're guiding for a 20% compound annual growth rate until 2028. That would land them at roughly $2.1 billion of revenue for that year. They're also additionally guiding for pretty significant free cash flow margin expansion. They're targeting roughly 16 or 18% free cash flow margin in 2028. So you essentially have this business that is growing ridiculously fast, guiding for a slowdown in that growth. But again, I wouldn't be surprised if they massively exceed those targets. They consistently talk about how they have had 17 quarters of beat and raise as well. So there's that you got to factor in. But even if that doesn't happen, even if we get to $2.1 billion of revenue in 2028, no matter how you kind of look at it, that should result in, assuming the multiple doesn't decline from this point on, that should result in at least a 20% CAGR, with the upside being significantly higher than that. In fact, if we jump over to my spreadsheet, again, if we assume sort of a 20% revenue CAGR, for cash flow margins go to 17% by 2028. And I'm actually saying they dilute you by 3% per year, which again, if we go look at the investor relations page, that's what they've guided for just this next year. I don't know about 2027 or 2028, but nonetheless, I'm just keeping that in there to be ultra pessimistic. And so I've put the price to sales at the bottom here, but as you can see, if they roughly trade at the same price to sales that they're currently trading at, that should result in a 20% CAGR. And if they trade up to even just say a 5 times price to sales, which again, it's not like that expensive, particularly for this style of business. As I just showed you, these companies generally trade at a massive premium in terms of the valuation. Considering the growth, the stickiness of those revenues, et cetera, you're comfortably looking at north of 30% CAGR. This should be a $45, $50 stock at least by the year 2028. And of course, if you want to be way more aggressive in terms of the valuation, say if it were to go to roughly 10 times sales, you're looking at a $90 stock in the year 2028. Now, do keep in mind that this spreadsheet that I built, this is just to kind of give you a range of possibilities. This is not a guarantee that this company is going to go to $90 per share. That's absolutely not what I'm saying here. I'm just saying, depending on what valuation the company has and depending on how the growth of the business is going to play out over the next handful of years, that is sort of the range of possibilities with this business. Will it be a volatile ride for us to get there? Absolutely. I mean, as you can see, even over the past 2 weeks, the company is down, I think, 20%. So you got to kind of have a stomach for this sort of stuff. Just in the past month, it was at $25 a share. Now it's at 18. That's roughly a 25% drawdown in the stock in literally the matter of weeks. So these things are quite volatile in that sense. And so you always got to keep that in mind. And before we end off the video here, I didn't mean for this to be some sort of comprehensive thing. I just wanted to do a quick update on my portfolio moves. Another question that consistently came up with a previous video that I did on the business was this company primarily derives its moat from first-party data. And so, Arya, what is stopping a potential competitor of Zeta, for example, a Salesforce, for example, and Adobe on their marketing side of the business, what stops them from also buying first-party data? Which is a very, very valid question, by the way. But I would ask you a question in return, which is, what is your definition of first-party data? Because there is Meta, for example, or Google, for example, they have first-party data, but they have first-party data in the sense that they know what you might be interested in watching next. Again, Netflix has first-party data. But that first-party data is only relevant in terms of what Netflix thinks is interesting to you that you might be interested in watching next. Meta, again, if you're scrolling on Reels, what is the content that you might be interested in watching next? That's the sort of first-party data that those businesses have. And so the difference with Zeta's first-party data and those walled gardens' first-party data is the data that Zeta has is intent-based. What intent-based generally means is based off of your online activity. So if you're looking at, for example, a newsletter on auto insurance, right? That's always the example that the CEO even gives. If you're looking at a newsletter on auto insurance, that very clearly speaks to potentially what you might be interested in buying next, right? Whether that would be auto insurance itself, or if you're interested in potentially buying a vehicle sometime soon, whatever the case may be. So this is intent-based data based off of your web traffic, and particularly what gives Zeta the moat as opposed to even say a Trade Desk or some of these other competitors that also are able to track your web activity. Zeta primarily acquired this first-party data through an acquisition of Liveintent. Now, Liveintent is a company that essentially publishes the newsletters of very large Fortune 500 companies. So, for example, some of their customers are, as you can see here, is AT&T, Dell, Walt Disney, Citigroup, Kohl's, Lowe's. There's additionally, like Disney Plus, Hulu, Uber is another customer. So the newsletters of these massive companies, Wall Street Journal, New York Times, some of these like news websites as well, right? So all these different massive companies, they of course have newsletters, and these newsletters are being consistently published. And so when you as a user log in with your email address and opt into one of these different newsletters, Liveintent is able to see that information. It's a hashed email, so they don't actually see quite literally the letters or like your exact email, but they see like Zeta ID 12345, whatever the case is. But then when they have that information, once you opt into that email or opt into that newsletter using your email address for example, Disney Plus, and then at the same time you opt in to a Wall Street Journal newsletter, when you're reading in Wall Street Journal about potentially auto insurance, they can cross-reference that, and they could see, oh, this Zeta ID 1234 was looking at auto insurance over here, but then additionally, that same email address is over on Disney Plus, and so they know that they can target you across these various different companies. So your web traffic that is over on the Wall Street Journal website can feed into an ad for a customer of Zeta, for example, a Ford, and they can put a Ford F-150 ad in Disney Plus because they know these two emails are connected. And so that's where the moat ultimately comes from. Now, again, there's a very valid question of why can't a competitor just buy the exact same data? If they were able to acquire it so easily, why can't Salesforce also buy this first-party data? And the answer to that is kind of multifaceted, but it really comes down to two different things, because Liveintent can connect both the advertisers and it can sell you that ad inventories, right? It's a two-sided network effect. It's selling you the ad inventory, and additionally an advertiser, for example, a Nike or whoever, the Ford F-150, they're able to partner up and sell that ad inventory using Liveintent. So it's a platform. It's a two-sided network effect. And again, 80% of the premium publishers on the open internet already use Liveintent. That doesn't mean they're necessarily exclusive to using Liveintent. I'm sure they use a variety of different publishers for their newsletter, but the point is they already have something that's already working. I'm assuming a large majority of their newsletter usage is already going through Liveintent. There is that network effect in place. It works the best because it has the network effect. And so there is competitors to Liveintent that are able to get you intent-based data, but it's not going to be as high quality as Liveintent. And this comes from Nick Wealthmatica. Again, I'll link it in the description if you want to go check out his content, but he gave the analogy to me where he's like, you could kind of think of it actually as Twitter, where like, sure, a thread might come up, but where do people break news? Where do people go to kind of, post all this content when there's breaking news of, oh, Trump did this or Trump did that, whatever, XYZ geopolitical thing just happened. Twitter has become the town center of breaking news to the world. And so sure, there could be a threads, and sure, threads could actually have a lot of cross-posting in terms of people that post on Twitter. They also post on threads, but Twitter, it's a network effect where there's the most amount of users and there's the most amount of content creators. And so that has ultimately become the default town center of breaking news, right? You could think of it as, for example, 80% of the premium content creators, the biggest content creators, quote unquote, are already on Twitter. And so that network effect is going to be a virtuous cycle and continually get bigger. The same thing could be said with a Liveintent. And what's key here is Elon Musk bought Twitter. Odds are Twitter is never going to be sold again. There's nobody that's going to ever probably buy Twitter from Elon Musk in the very, very distant future. Maybe it happens at some point, but for the foreseeable future, Twitter is just off the market. It's owned by Elon Musk, and that's that. The same could be said with Liveintent. It's the biggest premium publisher of newsletters. It has already been taken off the market. Zeta bought it. And sure, there can be a quote unquote threads competitor that comes along and also becomes sizable and that becomes a worthy asset. It's never going to be good as Twitter. Threads will never be as good as Twitter. The same way a competitor to Zeta can come along and develop some sort of network effect. When the default standard of the industry has become Liveintent, there's not going to really be a second place that is equally as good as, say, Liveintent, right? I hope I'm making sense here. And then again, another quick shout out to Blossom for sponsoring the video. I'll be sure to link my portfolio in the description down below. Again, completely free to join. So if you're curious to see if I'm buying more of Zeta or if I'm buying some of these other holdings, I've talked about ASML, potentially trimming that business over the past little while. So I'll be sure to update that as soon as I make a decision on that front. The original Zeta video should be up on screen now. Thank you very much for watching and have a great day.